Hi, everyone. It's Matt Donaghue with Mission Financial Planners. This is your weekly update for the week beginning July 14th. Let's go ahead and jump into it. Initial jobless claims fell to 227,000. That's a sign of continued labor market strength despite tighter financial conditions. That number shows resilience, and maybe it gives the Fed a little bit more flexibility. This week, we're watching consumer price data is coming out, retail sale numbers are coming out, and so is the University of Michigan's Consumer Sentiment Survey. Each one can move markets or potentially shape Fed policy, so yeah, we're paying attention to those. Economic forecasting has never been easy, but lately it's been more like trying to navigate a hurricane blindfolded. The culprit? Tariffs. Not just the ones you hear about, the statutory ones, but the effective rates that importers are really paying. For example, the headline might say a 25% tariff, but with exemptions, quotas, and shipping delays, the real rate could be much lower. This week's chart shows the divergence between those two rates. You'll want to check out our blog post to view that. Imports from China, hit with effective rates as high as 40%, have cratered, down 24% year over year from March to May. Meanwhile, imports from the Eurozone, facing just 10% tariffs, are surging, especially in pharma. Importers are playing chess with supply chains to try to dodge the worst of the trade war. Where does it go from here? A 50% copper tariff is already announced. Talks with Vietnam just ended in a whimper, not a deal. Bottom line, more tariffs are likely. That means more volatility and more pressure on companies that import raw materials. Investors need to stay sharp, manage your exposure, and stay nimble. Some wisdom for the week from Epictetus: every great power is dangerous for the beginner. That applies just as much to investing as it does to life. Quick successes can lead to overconfidence, and overconfidence can lead to mistakes. So don't skip the fundamentals. Stay humble, right? Try to stay diversified, stay invested. Tax tips. This week's tax planning tip is about something simple but powerful, teaching kids about how to manage money. Start early, set the right example, skip the allowance, make them earn it. Pay for chores, pay for grades, pay for reading, pay for whatever it is, but make them do something to earn that money. Use clear piggy banks with little kids so they can see their money grow. And when the time comes, don't buy them a car, sell them yours at trade-in value. Teach them to save, budget, be responsible. You want to help your kids be self-reliant financially? That's the best legacy you can leave. Speaking of legacy, let's talk about caregiving, which is really just a labor of love, but it is draining financially and emotionally. If you're a caregiver or you might become one, here are a couple of tips. Number one, talk early and openly about money, what's been set aside, what's been put in place to help pay for the care. Review your estate plans. Folks, I got to tell you, the powers of attorney and also the medical directives, you've got to have those in place. Organize your financial documents now before there's a crisis. Understand your loved one's wishes and put them in writing. Get legal and financial help when you need it. And knowing what public benefits are available, especially if you're a veteran, can be super important. Most importantly, though, take care of yourself. Caregivers, in many cases, will forget their own needs, and that's a fast track to burnout, disease, and an early demise. Lean on support networks. Talk to your employer about benefits if you're still working. Talk to your friends. Talk to your family. You're not alone. So whether it's tariffs, taxes, raising kids, caregiving, don't go it alone. If you're ready to talk strategy, click on the link or schedule a call to missionfinancialplanners.com. Thank you for watching. Stay smart, stay grounded, and we'll see you next week. Bye-bye.